The broadcast is now starting. All attendees are in listen-only mode.
Hello, Eagles. Let's have a great week. Just like the Eagles had a great night, one of the best Super Bowls I've seen in my life, and I'm not a real young guy. So everyone doing okay? We want to apologize for the little technical issue with GoToMeeting. Face has just been so darn popular that everyone registering over the last 10 months, it just took up all of their bandwidth and blew it up. Blew up the darn thing. Hi, Jess. Nice to meet you. So welcome back, everybody. I had a hard time getting to sleep last night. So if you remember last Thursday, I was talking about this pattern and euro pound didn't look complete to me. So if you did anything on that, you have about 50 pips made here. Talked about it in here. I was saying, everyone keeps waiting for a breakdown and maybe it's going to happen, but it sure is taking a long time. And I thought that euro pound could go up not because of euro strength, but because of cable weakness, which has been the case the last couple of days. So we had a nice pop in the dollar, and it was an inside week. And perhaps it's going to make a stab up here towards the 89 level. Maybe this was it. My RSI work says it wasn't. There was divergence, but that reading at 18 is very extreme. Your best divergences happen above 30. So what I'm thinking is, even if we rally a bit more, that there's one more low, and I actually think one more low is what's going to propel the S&Ps to give it a bounce. Okay, some more dollar weakness, and the fact that EG is stiff tells me there's a chance that maybe the pound doesn't, but perhaps the euro could still squeak out a new high. With all the dollar strength on risk off, they really haven't killed the euro. So the euros may be one of the only ones I went short because of its relative strength and because of EG. But again, I want to stress, if you took the trade Friday, any of you guys along from when I talked about it? Okay, great. I believe in taking partial profits. So here you have partial profits, you book it, and you move your stop to BE. So we'll see what happens with that. The Russell should break down today. Here's your daily. Well, that's a 4-hour. But look, we're right at the wedge line as the Friday's close. So we'll see if we get a breakdown here. We had glaring divergence compared to the S&P and Dow. The RSI structure was so much weaker in Russell. That's why it was a preferred short. In fact, I was early on a bearish ETF, but it didn't hurt me as much as it would have if I went with an ETF on the Dow or S&P, because while they eked out new highs in Russell, the S&Ps exploded for I don't know how many handles, and the Dow for I don't know how many hundreds of points, where I was able to withstand this. And now in the money, and this is my wet dream target here. Everyone see this, about 134 into March. Okay, so that's about all I have to say this morning. We have a great guest, Peter Atwater. He does a lot of socioeconomic work. So I read a few of his headlines on his website. Should be an interesting conversation. Invite everyone to stick around for that. The guests can round out what you're trying to do. Some are more micro. This is going to be pretty macro. That's my guess. First time I've interviewed Peter. But his writings seem very interesting to me. I'm looking forward to it. So let's see what the team thinks after a panic Friday. I made one of my luckiest calls on an interview with Larry Pesavento, who's a legend. I used to follow his work many years ago. He's one of the first to start using harmonics. But I was on a show a week ago Friday, and some caller called in and said, give me a trade for the short side of S&P. So I said between 28.70 and 80 with stops over 29 with a 27 target, and it turned. Part of the reason for the call was during the session. That's how valuable being in face was. Even helped me on my interview. It was Blake that showed a formation going to 80. Okay. So I'm a big believer in intelligence gathering, and I get a lot here with the team, and I bet you guys do too. So let's see what Blake is thinking. I didn't have a chance to look at his week ahead video. I think everyone should. I was away at my in-laws watching the game, and 3 hours of, come on, let's get this game started already. Anyway, how you doing today, Blake?
What a great game. I thought it was a great Super Bowl. If you weren't a fan of either team, it was a good, I don't know, it was a great content. Yeah, that's all we can ask for if you're not like a diehard fan of any one of the teams that are playing. It was a good, like you said, is a good contest.
Well, the Super Bowl indicator, I guess, would say a continued bull market, right?
Yeah, that's what it says supposedly. I mean, I don't believe in any of that stuff. It could have gone either way, and that's still not going to influence the way I trade the markets. That's for sure.
Yeah, I believe in the moon more than the Super Bowl indicator.
I actually probably would too. So the Super Bowl indicator seems like borderline ridiculous to me, but it's been one thing that obviously we can talk a little bit about equities here is that we've seen a pretty dramatic sell-off. I think we're going to end up stabilizing for the next couple of days. And here I'm just deleting that bear flag that we had out of the S&P. The S&P has sold off to the 618 retracement of the entire month. So, and we're consolidating. I really wouldn't be surprised to see us bounce, the next couple of days, Monday, Tuesday, and then see some resume selling into the end of the week. I think we're going to end up doing something like this. If I had to guess, I'm not, when it comes to trading the FX market, like how am I going to deal with the risk on, risk off? I'm not too sure. That the dollar has been really quiet since the open. It's actually been somewhat boring. I mean, yes, the euro is down a few pips, but really the euro is holding up fairly well. The pound has sold off a little bit. I think the pound is at risk of putting in a major lower high, which may suggest that the pound comes down a little bit more. Obviously, the commodity currencies are in a little bit of trouble right now. You got the Aussie that's trading pretty heavy, the Kiwi that's trading heavy, and the dollar Canadian came out of a descending wedge, and it's pretty well bid. But I don't know if we're going to get follow through today. I'm a little hesitant that the stock market might see a little bit of a bounce here, and what happens to the dollar if that transpires. I don't think the dollar really has too much life here at the moment. But when I'm looking at like the dollar, we really need a scale. This actually, I'm going to adjust this right here. We need to really get over like the 89.70 or so before the dollar starts feeling a little bit more like a recovery is happening. The dollar is not as responsive as you would have thought on this equity market sell-off. So if the equity market bounces, will the dollar just stay kind of weak? I mean, that to me seems fairly logical. There's not a lot pushing the dollar as of right now. I mean, the dollar is simply going to be a product of a short squeeze, if anything, because the data has not been driving the dollar. Yields haven't been driving the dollar, and yields are down today. So, I think the dollar's feeling that push pull in the markets. I think if you want to really get a good idea of how risk appetite and risk aversion is working right now, you probably pay attention to the yen pairs. You have the dollar yen. It had a nice recovery out to the 38% retracement. We've turned away from that. The euro yen is weakened but is really at the breakout point. The pound yen looks like it's in a little bit more trouble. The pound yen has come under some pressure after hitting a new brief high. The Aussie yen is actually trading at very, very critical support when you're talking about risk aversion, risk appetite. And I think the Aussie yen is still going a lot lower here. It's just pausing at the moment. Kiwi yen's little bit of trouble, and then the Canadian yen is a little weaker as well. But it's been a really quiet, open for the U.S. dollar. You look at the U.S. dollar and you're like, okay, well, what am I going to do here? When I woke up this morning and I jumped in our private chat room, and for those of you guys that are, not part of the ForexAnalytix community, that's one of the highlights of the ForexAnalytix community is being in our chat room where I'm at all day long. When I jumped in there, and here I'll just so you guys can see, for those of you that are not familiar with it, that's all of us right here. You can see there's about 85 of us, 84 of us in there right now. And you guys can say hello. Hello. So when, in here, all the guys and gals were like, they were like, hey, it's been really frustratingly quiet, in the FX space, all night long. And that's really what we've seen thus far. I think at this point in time, until the euro breaks above 125 or below 124, it's going to be a very tough read as far as what the cable has to stay above 140, Simon. Here, I'm going to put this over here so I can show you guys some of the prices. But here's the euro above 124. As long as we're above 124 here, there's not a whole lot to do. The pound, again, 140. I think that's going to be pretty key support here for the cable. There's no sense in trying to chase it down here while you're approaching 140 if you're bearish. And again, it's kind of quiet, Dale. It really is. And we do have some news coming out today. We have a lot of stuff coming out this week, but the ISM services data, we've seen data being released here in the US, and the data being released hasn't produced really, even if it's good data, we've seen the market just fade that here in the US, and they just fade the dollar regardless. I don't know if the dollar dynamics are going to change a little bit. I think the FX market is a little stunned with the 5% sell-off that we've seen in equities thus far. So with equities, coming off really, as fast as they have, I think, a lot of people are trying to figure out what are we going to do with currencies? What's the response here in the currency market? I really do think that if things continue to worsen in equities, the dollar will catch a bid. We'll start to see, more of a risk-off tone in the currency market where the dollar performs better than other currencies, just as people, decide, hey, I want to go back into cash. But I think, like I said, this sell-off was fairly dramatic in equities, and so now the currency market's just trying to figure out what the appropriate response is now that we're here. And it's been tough because we haven't seen any type of real risk aversion this week. So, or effort for, I say this week, we haven't seen any type of real risk aversion in months and months and months. And if you look at equities, I mean, the last time that we saw any type of, selling was really in the summer, and that was, very moderate. So this type of move has really, set off a lot of alarms for traders. But at the same time, in the currency market doesn't really know how to respond to it. So it's going to be really interesting to see how the dollar starts to operate in this environment. And if the dollar gets sold, then the dollar's in a lot of trouble. If the dollar is like aggressively sold when stocks are going down, that's going to be a pretty pretty alarming for me as far as what we're going to do, what we're trying to do here in currencies and how we're trying to trade it if the dollar really comes under pressure. I do think that the commodity currencies will continue to underperform though. So whether you're talking about the Canadian or the Aussie or the Kiwi, those are probably going to be currencies that continue to stay pressured as stocks are. And matter of fact, let's take you over to the Aussie because this is really important. If you look at the Aussie dollar, and this is a weekly trend line here, okay? All right, you see it right here. And we broke out of that like a couple, 3 weeks ago. All right, you can see the Aussie broke out of that. We're back retesting that trend line right now perfectly. And matter of fact, let's grab this fib and go all the way down here. That's a 38% retracement. So and that comes in basically at 79 cents for the Aussie dollar, where we did find some support overnight. If the Aussie dollar breaks this right here, if it breaks that 79-cent level, I think the Aussie is going to be in for a lot of it's going to be very troublesome for Aussie longs. So that's something that I've been looking at and, kind of wondering, okay, is the Aussie going to feel any more heat here with equities coming off? And I think that line in the sand for the Aussie dollar is 79 cents. Below 79 cents, you're going to see a lot of long liquidations, especially those that have been buying it up all through December and early this month or early in the year and then into January. So 79 cents is going to be pretty key here. But yeah, it's interesting, Dale. I think the market is at a bit of a standstill, the currency market, as traders are just trying to figure out what the heck to do. I personally think that the dollar is now, you want to buy it on pullbacks from a defensive standpoint. This risk off is probably, solidified a near-term low in the dollar index, but we haven't seen the dollar really start to explode higher at this stage in the game. But I think that the stock market sell-off has put in at least a near-term bottom for the dollar. I think but I'm not super confident about it either. The dollar's been in a severe beatdown mode for so long that it's hard to stand in front of that as of yet. But there's a lot of key events happening this week. If you guys didn't listen to the week ahead video, if you were like Dale and you slacked off and you just watched football all weekend and, hung around family, I'm just kidding. I did a lot of the same, minus making the video. We do have the RBA this week. We have the RBNZ this week, and we have the Bank of England this week. So we have three central banks. Even though nobody's expected to move on rates, we're not expecting, the RBA, RBNZ, or the Bank of England to do anything super exciting this week.
Yeah,
Hey, what's up, Stel?
we have the Bank of Mexico as well.
Oh, we do. What day is that?
Good question. I need to find that. I think it's near the end of the week. Hold on. I need 10 seconds to find that. My dog maybe knows.
Sounds like your dog knows.
Sorry.
I'm looking too as well. See if I can find it here.
Okay, it's Thursday, and we're expecting a 25 base point hike.
Okay. Oh, okay. So oh, yep. Okay. So I'm seeing it here. That's not a calendar, even though I do trade the peso pretty actively. It wasn't one I was paying attention to. So thank you very much. So yeah, I mean, so there we go. We have one actually central bank that's going to be making a move on rates, but not the RBA, not the RBNZ, and not the Bank of England. Now, Stelios, since you talked a little bit. Now, as far as the Bank of England goes, we also have the inflation report. Are we expecting anything significant out of the Bank of England on Thursday?
Yeah, nothing major is expected. We have to note that the inflation report months are the critical ones always for rate moves, and they always have been. So February, May, August, November. I don't think we're expecting anything groundbreaking, but with inflation sticking around 3% and all that, it might change the rhetoric a little bit. But I think overall, we're not really expecting any fireworks on Thursday.
Definitely. Good morning, gentlemen.
Good morning.
And all. Definitely, Stelio, we don't expect any dovish surprises anyway.
That's for sure, yes.
We've seen such a big recovery in the cable, following, as everybody is taken back a lot of the post-Brexit move. Yet we are still faced with Brexit and a lot of uncertainties here. So how do you feel about the cable? I mean, you've been, Stelios, you've been very bullish the pound ever since we were down in the 120s. And here we are now in the 140s. What is your opinion on the pound from a macro standpoint at these prices?
Yes, I am still bullish the pound from a macro standpoint. For me, nothing has changed. If anything, the Bank of England is going to try and fight inflation, which is here, and we can see it in earnings and in CPI. So I think the market's pricing a very, very shallow hiking curve. I think they're probably going to surprise on the high side. Now, for sterling against the dollar, I am no longer bullish cable at these levels because I am starting to get a pretty bullish dollar as well. So for those two, I'm not sure about cable, which way it's going to go. I'm kind of neutral, but I am bullish sterling against the euro and the Kiwi and some other currencies. But
it's interesting. You're not bullish the cable, which is the pound US dollar at these levels. So what makes you so bullish the dollar at this point? Because, like I said, I'm struggling with the idea that the US dollar really has a couple of legs to stand on at this point. I'm not, really too sure that the dollar has a whole lot in it from here. So what makes you feel that way?
I think, first of all, I've been pretty bearish the dollar for months now. Now I'm starting to turn a lot because I think we're going to see what we saw with the pound, with the depreciation of the pound. So we're seeing a big leg down in the dollar, a very sharp move. That has already started to manifest itself. Remember last week, average hourly earnings spiked up. I think we're going to see inflation starting to spike up. It's not the right kind of inflation because it's not demand-based inflation, but it's going to be currency-led inflation, which nevertheless is still inflation. So I think we're going to start seeing that. And if you look at the US in terms of economic data, in terms of how things are going, things are pretty good. Unemployment, growth. Okay, maybe the quality of employment isn't great, but overall numbers are pretty decent. The only thing holding back the Fed, we've said this before, was inflation being sticky at 1.5%. It's not at target; it's below target. So I think that's going to go, and when that goes, then I have a feeling the Fed is going to be forced to act maybe a little bit faster than expected. In the medium term,
anyhow, the inflation mandate is close to 2%, right? It's not higher than 2%, and we are already there, aren't we? I mean, what was the last CPI print? Was it the core was like 1.8, 1.9, and 2.1 was the basic one? I mean, so more or less, I mean, theoretically speaking, Fed has already fulfilled all its mandates, right?
Yeah, and they don't want to fall behind the curve. So I mean, in the medium term, like 3, 4, 5 years from now, I kind of think that when all these rate hikes filter through to the economy, it's going to put on the brakes on the economy. But for like the next year or so, I'm starting to get bullish the dollar. I never thought I'd say this, but I really am. So,
right. I was going to say this, but you know, it's interesting. I've been pretty much a dollar bear since last January, and you know, I've still tried to figure out, okay, well, why, you know, can I argue a bullish dollar at this point? And I still really can't. But you make some really, you know, some good points, but price action in the way the dollar has been trading as of late really hasn't signaled that we've made a tradable low. However, like I said, with equities now starting to sell off, you know, does this put in a backstop for the dollar? And that's what I'm wondering now at this stage in the game. It's like, okay, has the dollar become more of a value play? You know, when you're talking about weak equities, weak bonds, and stronger yields, does the dollar actually find its footing now? And so that's where I'm at, and it is a tough, it is a tough call, but I'm gonna stick by this. As long as the euro trades above 124, I don't think the dollar has a lot of technical reasons to be strong here, as long as the euro is above 124. The euro gets below 124, and I think that, you know, maybe that starts to put a you know, a bid in the dollar across the board, not just against the euro, but across the board. And that's minus the yen. I think the yen is going to be on its own program here. So, but with that being said, I'm gonna get back to my trading day, and I'm gonna pass things over to my my colleague Steve and Stelios here. Good morning, Steve.
Hey, Blaker.
How you doing? How you feeling?
I'm good.
The antibiotics sound like they have kicked in, and
I finished them yesterday night. Yeah, so I'm okay. Yes. Absolutely.
Oh, good to hear. All right. Well, how do you feel about the dollar at these levels?
Pretty good, actually. We still have some you know, way to go, but I do believe that if we actually do get this move going a little bit, so we can penetrate through 91, I think the market is going to squeeze a lot of people out. So I think the hard part is getting to 91. And after that, I think that positioning is going to do all the rest. So I do see the potential of a big squeeze coming. But as I said, the next few days are going to be, you know, quite important. So if we do see these big reversal moves that we saw on Friday, because on Friday we didn't only have big reversals on risk assets like stock markets, but we also had big reversals in the vast majority, not all, but in the vast majority of the dollar pairs. So I think that if this actually accelerates and we get a strong dollar week, I think that the positioning, which we've mentioned plenty of times, that has been you know, one-sided, it's going to it's going to do everything else. I think that positioning from that point on is going to take over and be responsible for, you know, the rest of the moves we're going to be seeing.
All right. Well, you know, we're definitely primed for a short squeeze out of the dollar. That's I think that's
all the elements are here. We just need it, you know, to start becoming a little bit more persuasive to market participants. And then I think plenty of them, and I'm talking about institutional investors as well, and you know that more than anyone, plenty of them are going to be content with the big gains they've got in any short dollar positions and any long risk positions. And I think it's going to be time they decide that, you know, okay, it's time we remove some of our exposure in the market. And as you know, that has, you know, that has the effect of accelerating moves, because then it forces more people to do the same, and you know, we get the snowball effect in essence, right?
Right, exactly. All right, well, I'm going to pass it over to you guys. Good luck today, and thank you, Steve, Dale, and Stelios. And I'm glad that you guys listening in have been able to find us with our new link today. So thank you very much.
Okay, Blaker. Have a good day, mate.
All right, you too. See you guys.
Bye-bye.
Bye, Steve.
Hey, Dale. How have you been?
Good, buddy.
I hear the vast majority of you Americans were watching US football yesterday, right?
Yeah.
And I heard you enjoyed it. Okay. So it was good, huh?
Yeah, breathtaking.
Was it as breathtaking as Friday's price action?
Yeah, more.
Okay.
Because Friday wasn't a surprise to me, but the Super Bowl, I was rooting for the Eagles because, they haven't won in a long time, and Tom Brady has won plenty. And now that we call our attendees and face the Eagles, how could I not be for the Eagles? So
that's a good point.
Yeah, and plus, the quarterback from the Eagles almost retired a few years ago. He's kind of a journeyman, never a superstar. And I love to see, naysayers. And when he came in to replace Carson Wentz, who's their, he's a phenom, they didn't think Philadelphia could, they thought they'd fold. And it's funny, his last name is Foles. But what a great job he did. So, yeah, I'm happy for the guy.
These are usually the nice stories in sports, right?
Yeah, the underdog, the
underdog, yeah.
Like me.
Like you, why? I don't feel you're an underdog.
I bounced around a lot in my career. You bounce around. I've had my own IB, so I've done a lot of different things, and I'm not saying I haven't gained wisdom from it, but never one of those. I'm not. What's his name? Paul Tudor Jones. So, the majority of retail traders have to go through difficult times until they have success, and it comes and goes.
That's true.
So, I consider most people everymen that are in their, walking their road and overcoming obstacles. And so I consider myself one of those. Lots of obstacles in life,
Yeah, so, but you're a fighter.
Well, you don't know what you're made of, until you face adversity. Everyone could be like full of faith and, oh yeah, have a positive mental attitude when everything's going okay and great. The test is when it isn't.
That is very true.
I rest my case.
Wise words.
Okay.
So let's go to the markets, and I see a lot of people asking.
Words from a wise ass. Right? Dale's a wise ass. Yeah, no, you got a lot of questions here, buddy. David thought it was funny. See, David,
we do have a lot of questions. Needless to say that just to give you an idea, and this is honestly like seriously impressive. The SPX DSI readings have dropped like within a week from some spectacular
90.
Yeah, I mean, we were seeing numbers like 96 and some
50 now,
below 40.
Oh wow. Yeah, we're gonna get a rally. Maybe it's just going to be a big ABC, Steve. Maybe we're finishing A here.
Might be, but we had warned plenty about this. We had warned about the parabolic nature of this move, which was accelerating. We had warned about this pitchfork that we were actually almost testing, and this proves once again what they say that, you know, especially in this case of parabolic moves, this is a weekly chart of the SPX, by the way.
Yeah.
You know, it's up with the escalator, down with the elevator. Just to give you an idea.
Can I see your Russell chart and see where your lines are on that now?
Within 5.5 days, we retraced 3 weeks of bullish price action.
Yeah.
So in essence, within a week, we retraced more than half of the gains. Actually, like two-thirds of the gains if we take the lows of the overnight lows that we've been seeing all month. So, you know, that is why we were warning, you know, for multiple days with Blake and in ForexAnalytix that, listen, yeah, obviously, you know, it's very bullish, etc. But, you know, this is not a market to be long anymore because, you know, this market is at huge risk. That's why we were also showing the reliability of the signals we've had whenever the VIX, because the VIX was sending signals in advance, right? Dale, let's go to the daily VIX actually. So the VIX was in essence for the vast majority of the month positively correlated with SPX, which is like an extremely rare event. And that's why we're showing that whenever correlation is turning positive between the two of them, in the vast majority of the cases, we've had corrections lower. And this is what happened here as well. The VIX was sending signals in advance that, you know, implied volatility shows something different. SPX was completely ignoring everything that had to do with fundamentals. The fact that yields were increasing at an accelerated pace, the fact that valuations in many aspects had become ridiculous, the fact that there are still a lot of risks, and suddenly, as it always happens, one day, you know, the market wakes up, you get a 2.5% lower, and suddenly the vast majority of the titles I was reading during the weekend is, you know, it's like it was the apocalypse, and everybody suddenly realized and woke up to the fact that, yeah, okay, perhaps like getting a 10-month up every month is probably not something normal, and that, oh yes, the market is probably ignoring things that it shouldn't be ignoring and things that were obvious, but you know how titles are following the price action instead of leading the price action. So, you know, price action creates its own narrative, and that's why in the vast majority of the cases, I mean, for example, I'm a subscriber to Financial Times, and I do read like anything that has to do with geopolitics, etc., and general news. But reading like you know, articles about analysis, it's almost always useless because it just you know, in a retrospect tries to explain why something has happened and not look forward of why something might happen. You know what I mean? So we've also seen a very big move in the Aussie. Blake mentioned it. If you remember, I was adamant that I remain very bearish at the Aussie. I know that Blake has a different trend line, but this is the trend line I was following, and this is the confluence of resistances we were following. We got a major rejection from there. Overnight, I got limited out of 1/3 of my short position for 1.85% profit. I still remain short with the other 2/3 of my position because I'm really looking as a high possibility that after a little rebound from here, we might get another leg lower. Ideally, I would want to see this area tested, the 77.40 area tested. It's horizontal support resistance area. Also the 61.8. The 200 EMA is also there at the moment. So for me, this is a perfect area to at least finish a correction if this is not the beginning of something bigger, because as I've said, and we've shown the big picture, you know, I have no reason to believe that, you know, in the grand scheme of things, this is anything more than a corrective move. This whole move that we've had higher since the beginning of 2016, I believe it's a prolonged correction to, you know, a strong move lower. So regardless of what it ends up being, I do believe that we shall see more downside, perhaps after a little bit of a pullback, right? So more or less, I think the Kiwi is obviously lagging the move to the downside, but I do think that it also has the potential of catching up. still stubbornly holding here. But I do believe that, a retest of this 73.30 area we've already tested once again might make it fail and push it at least, for the next objective, which is 72.20. So in general, I would, warn that you should be cautious in any dollar short positions that you have. We are seeing an attempt to create like a short-term bottom here. Of course, this might prove to be just another bearish consolidation, and we might see another move to the downside. I'm the last person that's going to advocate against, believing that, trading with the trend isn't the best alternative. But what I'm saying is that, positioning is extreme. The market's views are a little bit flawed in several aspects, in my opinion. And, if we get a little bit of a squeeze and we penetrate through the 90-10 area and then 91, I do think that then, as I said to Blake, in my opinion, extreme positioning and profit taking is going to do the rest of the, stuff. So, as we've said before, I can't tell you in advance that, I can exclude another move to the downside for dollar, but I can tell you one thing for sure. This is not the place that, reward to risk ratio makes sense being short. It really isn't. So in my opinion, you're either short. So in which case, just be cautious and make sure you protect your profits and not get let the market, move against you and eat them up. Or you're not involved, in which case you're either trying to find an opportunity to be long for a counter trend move, or an opportunity to be short on a rebound, or just stay out of the market. Because going short here, where would you put your stop loss? And the risks are, in my opinion, uneven. I mean, not worth it. We're also seeing some pressure for the cable, by the way. But I have to say that, irrespective of the move lower we're seeing here, which of course has the potential of pushing lower, I would have to say that, we need to see a lot more to be persuaded that, this is going to be more than a corrective move, simply because cable has been extremely well bid. I mean, we haven't even registered a lower low from here. So this might even prove to be like a short-term triangle of some kind. Even using this ascending channel's resistance as support, we can see that this can be interpreted as a triangle. So, I think that cable and euro, which is also holding very nicely, Blake mentioned it. We are on some kind of resistance having to do with the euro, by the way. I'm tracking this ascending channel, which we haven't managed to break above, and I'm even tracking this trend line as a potential ascending wedge here. But it's undoubted that the euro USD remains very well bid. The next upside objective is pretty close. It's the 61.8 fib at almost 126. Obviously, if these two break, the dollar is going to accelerate to the upside. But we still need more evidence. So we obviously have a picture here that it gives us the following information. We have some dollar strength against mostly commodity currencies, and I'm going to show the USD CAD afterwards. And euro and cable, especially euro, are holding better. As you understand, this also adds fuel to the fact that the moves higher we saw several days ago in the cross rates indicate that they have found some bottom, and they remain bullish, like Euro Aussie, Euro Kiwi, Pound Aussie, Pound Kiwi, etc. Let's go to USD CAD, and then I'm going to show you USD Yen. Okay, USD CAD. I was watching this as a potential descending wedge. Obviously, Friday's move was extremely impressive. But the real test is here, right now. I mean, it's this area, right? You can see it here, this horizontal support resistance area. We also had RSI divergence, which, also indicated, the potential of a bounce. Friday's price action was perfect, a perfect breakout of a descending wedge. I think that if we close above this, then a move towards this previous range of support at 126.60 is a very, very high probability move. So in general, against the vast majority of commodity currencies, dollar started looking really nicely. USD NOK also had a very nice move out of this descending channel on Friday. Obviously, we need to see some follow through to all this, right? But I'm just saying that some setups are, almost ready here. USD yen, we got a strong move higher, but we got rejected. I mean, we closed the day right on previous support, now acting as resistance. And yesterday night, when the markets opened, we respected this. We moved to the downside. So especially having to do with the USD yen, and especially as long as risk aversion will be the theme, which might only be like a few days, because we know that the trend in risk, remains high until proven otherwise. I think particularly interesting are some of the yen crosses, right? Because USD yen might see limited upside. We've already seen a rejection from this 110.15 area. And as I said, commodity currencies remain under pressure. So, for example, if we have a look at Aussie yen, which is breaking below a range, which would trigger this being a double top, and that should bring more weakness. So let's see how we close today. But if we actually close below that low, I think it's really a bearish signal. Kiwi yen, which is still in its range, but a break below there has the potential to accelerate to the downside. CAD yen, okay, if we break below there. So I think this might prove to be a very interesting week. We already had like Friday being, a very, very interesting day. It was the last Friday was in essence the last trading day of the month. I know it was 2nd of February, but I mean, it was still a week that started in January and was following the theme of January. So Friday, in essence, might have given a new pace for the month ahead. So I think today and tomorrow will give the opportunity to the markets to verify, to confirm, if you wish, if that's going to be the case. So I think today and tomorrow quite important days to monitor, so we know what the theme for this month is going to be. As we've said in the past, the chances of lows or highs being registered during the very, very last or very, very first days of a month are extremely high. So there is a chance that Friday, which was like the 2nd of the month, might have already set like some short-term bottoms or some short-term tops for several assets and asset classes. Okay. Michael says to have a look at the bonds. Yeah, absolutely, Michael. I know that the bonds have been seriously under pressure, and this is what caused, in part, the moves we've been seeing. The trend lower has been relentless. It actually accelerated. I do believe that if we get some continued risk aversion, bonds should rally somewhat. But still, I will be viewing any rally in this case as a corrective one. Okay. The next downside objective for the 10-year is the 120 area, which is the 161.8 extension of the corrective move that we had manifested from the end of 2016 until like September last year. I do believe that if we get up back to this area that we had this double bottom right about 123.20. It's going to prove to be major resistance. As we've also said, the bunds have also given such a signal. I mean, they broke lower from, a very key support level, that was holding this super long-term bull market intact. We're seeing a big rebound today in bonds, but I do believe that this area that was like very strong support for such a long time is going to prove a very hard resistance to crack from this point on. Okay, so what's like 159, 159.50 for the bunds? I think it's not going to be an easy level to penetrate above once again. Okay. Let me see what other questions we have. Eurocad. Yeah, sure, let's have a look at it. Who do we have today for an interview, by the way, Dale?
Peter Atwater, internationally known socioeconomics. He's been on every media. His articles have appeared everywhere. Should be very interesting. Great guess.
Yeah, it does sound interesting.
Like usual.
I have no doubt.
You're the guest, right?
I trust your taste in.
You're the guest.
Okay, let's see what other upside targets we have for. Obviously, Eurocad, is as I said before in my introduction. Crosses with the longest, the next upside target, which is something of the last corrective move lower, which is at 157.70, is like easily achievable. And in general, I think as long as we remain above this 152.60 area, even a pullback might easily find buyers once again. Okay, so I think that Eurocad is not the best looking pair out there, but definitely, at least in the short term, remains well bid and bullish.
Okay, Peter's here. How's the Russell look? Someone in the crowd. I don't know. His name's Dale. Wants to see your Russell 2000 chart.
By the way, Nasdaq. I'm going to go through all of them now, Dale. Nasdaq. You remember we had warned that I was tracking this as a potential ascending wedge. As you see, it worked out perfectly. I think the next serious support for Nasdaq is down at 65.17. What I wanted to say actually about both the SPX, about the vast majority of the indexes, and you're going to see that here, is that yes, we've seen some very big moves, and in the very, very, very short-term time frames, they're oversold given the moves we've had last week, and especially with the acceleration on Friday. But first of all, an index that plunges 2.5%, indexes that plunge 2.5%, knowing how bullish they are, the fact that they closed on the lows on Friday tells me a lot. Second of all,
what to tell you? There's vulnerable longs, right?
Yeah, absolutely. Second of all,
Steve, you bring up the 2.5%. You probably know about this. The 29 crash started with what was called a Babcock signal, which is 3% lower in a day. So we didn't quite have a Babcock, but
it was close.
Yeah, that's what I mean.
But it was close. And you know something, Dale? Look at these charts and the parabolic moves that we had during January. There is no real, and I said that even on Friday's webinar before we got the sell-off. There is no real support. I mean, look at this chart. I mean, the first actual support here is like at 65.17 for Nasdaq. Yeah. For the SPX is down at 26.90, 90.95.
Yeah.
For Dow Jones is like just below 25,000. Exactly. Yeah. IWM is the only one, because it hadn't rallied so much that actually found its first reasonable support, and it penetrated through it on Friday. Because IWM was not following the pace that the others were. So IWM had some solid support level here at 154.70, let's call it, but we did break below it on Friday.
Yeah,
of course,
I think someone was pointing out its relative weakness for about a month now.
Absolutely. And
so,
having to do with Russell, the next area of support, by the way, is decently lower. It's at 150.60. It was that.
Okay.
That other range that we had, it acted as resistance multiple times. Then we broke above it. It acted as support multiple times. So if we actually today confirm the break below this support zone, then I would definitely be looking for 150.60 to come next, and rather fast, I would say.
Yeah. If you draw a trend line off the low there, and it's actually breaking an uptrend from September.
And by the way, if you remember, a couple of days ago, this is what we drew in Nikkei, right? That we had that confluence there, and the break below it, boom. Look where it would lead. So Nikkei is not looking pretty as well, and definitely DAX isn't looking pretty as well, because first of all, it managed to close below this 12,900 area, because it's not a specific level, it's this area. It managed to close below it for the first time after a very long time. It's also now below the 200 DMA, and the only thing that is holding somewhat the bulls alive at the moment is this support of this megaphone formation. But if that also breaks, I think that then we're looking for 12,100. So, the DAX is also in the precipice. I mean, we expected a pullback back there. We had even drew it. I haven't changed anything on the chart, perhaps to come and retest 12,900. But we sliced through it like it was butter. Okay. In my opinion, the only thing that can save the DAX here, besides, of course, like risk aversion going away like immediately, is some euro weakness as well. So if we do see dollar strengthening and euro also showing signs that it's going to weaken against the dollar, that might actually save the DAX and help it hold this expanding triangle support. Otherwise, things look tough here as well. IBEX, quite ugly as well, testing horizontal support once again, faked out for one more time. I mean, people got really bullish, I'm guessing, on the break above there, especially given the prior trend. And then, boom, plunged. FTSE, you can see this outstanding move. I mean, we were noticing that this is a potential ascending wedge, which could bring the index, that's what we had drawn back then, which could bring the index back to retest that area. But not only we retested that area, but we actually it like died after that. I mean, it's 2, 4, with today it's 6 consecutive down days, or 8 out of the last 9 sessions were down, and the vast majority of them were like significantly down. So as you see, another like strong move higher is retraced in a fraction of the time it took to actually move higher. And, these are things that people are obviously looking at the moment. And as I said before, be very careful, because everything remained bullish, of course, but given how stretched, the markets have been, we're not far away from seeing people massively liquidating positions. So if for some reason we get a couple of more reasons, for the market to sustain a risk aversion attitude, and we get these moves extending somewhat, then, as I said, for the dollar, same applies for risk. Then weak longs, as Dale said, and extremely one-sided positioning is going to do the rest. Okay, and that's a very hard process to reverse afterwards. I was also reading a very interesting article indicating that for the first time on Friday, we had several billion, I think like $4 billion dollars liquidations from ETFs. And there are a lot of people saying and assuming that if people, which, huge part of the chunk of the money that goes in the stock market goes now through ETFs, if they start liquidating their positions in ETF holdings, we have no real idea how much that can affect the markets, simply because we never had ETFs, being, so significant in previous market environments. I mean, until the last business cycle, as far as we know, they were much smaller in size. So, these are things that you need to keep in the back of your mind. And I think the next few days might prove really interesting and challenging. And I do think that sooner or later, volatility will be here to stay with us. Because I do think that due to several macro factors as well, the recent multi-year environment that everything was peacefully, very quiet, etc., is slowly coming to an end. So I think that if we have to make an assumption looking down in the future, several months, etc., I think that trading is going to become quite more interesting than on average we had the past few years. So I think there are money to be made here if you are patient and you keep a clear mind and a level head. That's it, Dale. We'll talk more tomorrow. Enjoy the interview.
Okay, you want to pass me the screen, please?
Absolutely.
Thank you. Thank you for your analysis.
There you go.
Thank you, buddy. And Peter, welcome to FACE. I'm going to make you a panelist. I'm not sure if you brought anything to show, charts or anything, but I'm going to be showing your website right now. So waiting to hear your voice. And if you need the screen, I could pass it to you. Nice to meet you, Peter. Oh, hold on.
Dale, I don't think you've added.
I am muted.
I can see that.
Yeah. Hi, Peter. How are you?
Can you hear me?
Yeah, Peter, I could hear you. Can you hear me?
I can hear you fine. Great.
All right. So very nice to meet you, Peter. Thank you for taking time out of what will probably be another wild market day, but you're a macro guy anyway. I wanted to introduce you to our community by showing your website, Financial Insights with a Y. And you can see that Peter is, his work has been published everywhere. He's also he's an author. He wrote Moods and Markets. He's been on CNBC, Reuters, Financial Times, and even the right-wing Fox Business Report put you on. So that's great. And you're an adjunct professor at Lerner College. It's in Delaware. And you've done several TED Talks. So, gosh, Peter, great to have a guy with your background with finally a little bit of fear coming into the street late last week. So, how are you doing today?
I'm doing great. And this is really, you're right, this is a really exciting time to be talking about, fear and confidence in the markets, because I think we're at a critical inflection point, and one that's been obviously long in coming.
Okay, so, I've talked about your accomplishments. What always interests me, and I'd like to start there, Peter, is did you have an economics background in college? How did you end up being where you are now? What was the beginning of your journey like?
So I think of myself as having two careers. I spent the first part of my career on Wall Street working for JP Morgan, building their asset-backed securities business, and then working for one of my clients, First USA, a credit card issuer that got bought by Bank One, and then ran a variety of functions for that organization. And decided when I turned 45 and my then 6-year-old son told me that I was halfway to 90 to do something else. And It just happened to coincide with the financial crisis, and my background was ideal for helping a group of money managers and hedge funds navigate the crisis.
Okay, so wisdom from babes. We should always listen to our children. Plus,
Yes.
you probably were hardly around. You were so busy, and you found a way to spend more time with your family and still, keep your hand in the economy and the financial markets.
And it gave me the luxury, honestly, of trying to better understand why markets behave the way they do. And I stumbled across some work that Bob Prechter had done, and I think most of your followers will know Bob from his work with Elliott Wave.
Right.
But he's done some really interesting work in something called socioeconomics, which looks at the impact of mood on decision making.
And things like the kind of movies the public's watching and fashion and all of that. So with all this euphoria that we've had in financial assets, and last week may have been a crack, bond markets potentially in a bigger bear market than equities. What do you diagnose social mood as right now, especially with you can't even talk politics on Thanksgiving with your family anymore, or they won't talk to you for a month. So what is the social mood in the USA right now?
So I think I think there are two very distinct moods. Those who are closest to financial assets and technology are euphoric. Mm-hmm. The euphoria that you see measured by the Dow and the S&P is mirrored behaviorally in what I see, whether it's talking to people on Wall Street or talking to people in Silicon Valley. And where finance and technology come together, aka cryptocurrencies, the euphoria is cubed, quadrupled by that simultaneous combustion. And the cryptocurrencies are really important to me because it looks like that euphoria has exhausted itself. And one of the things that I observe over and over in history is that manias mark major market tops. Think about Beatlemania in the early 1960s. Perfect coincidental behavioral parallel in music with what we're seeing in the cryptocurrencies.
Interesting.
And the other thing I've noticed is the most outrageous, outlandish, craziest risk-taking arrives last at the party. If you go back to the mortgage peak, you had this onslaught of subprime mortgage lending. We were going to lend money to people who had no jobs, no income, to speculators.
Let me interrupt you. That's one of my shortcomings in an interview. You talk about real estate and the euphoria before the financial crisis. Isn't there as much euphoria now with real estate prices in the hot markets on the coastlines, even being worth more than they were at the peak in 07, 08? Every financial asset class of the wealthy has appreciated, and there's wild prices being paid for real estate, not just here. Toronto had a crazy bull market in real estate. Do you think that that it may not be a mortgage crisis, but that we could see that asset class, the air come out of real estate again as well?
Yes, particularly luxury real estate. If you think about what's happened in New York and all of those pencil thin skyscrapers, what's affectionately referred to as Billionaires Row. That to me is just a perfect embodiment of the euphoria that we've seen in luxury real estate that, to your point, has not only rebounded from the from the crisis, but has gone on to mirror the Dow and the S&P and its valuation.
I thought we'd have an echo bubble in real estate because of easy money, but I never thought that we would surpass the 2008 values like we have. And you know what, Peter, what do you think about, you brought up Billionaires Row, and there's big protests by one of the buildings, I think the most expensive building. Any socioeconomic hints or market tells with them putting a homeless shelter on Billionaire Row right next to one of the buildings?
Yeah, I mean, yeah. I think that's indicative of the real underlying social mood that exists on Main Street. I think we have a huge confidence divide that most of America
let them eat cake. Let them eat cake, right, Peter? I mean, it's almost like that book, isn't it? It's the best of times and the worst of times.
Mm-hmm. Yeah, it's very Dickensian.
Yeah. So, how does it resolve itself? And I did go and look at a few headlines on your website, and what interests me is one of your titles was "Don't Count on Donald Trump and Wall Street's love affair to last," because he's been, you have to admit, I mean, we rallied 30-40% since the election, and he talks about it all the time. What's going to be the catalyst for that love affair to end? A bear market?
Yes. And what you're seeing is, and to me, this is such an indicator of things to come. And you saw it last night at the Super Bowl. So you have this entrenched, extremely confident incumbent that is surprisingly upended by a group of underestimated, less
journeymen,
appreciated outsiders.
Yeah, love it.
And you've seen that with the rise of the Me Too movement and the rebellion that you're seeing with women against extremely powerful elite men, whether it's in Washington and in Wall Street, in Hollywood, in sports.
And it's effective for the first time. They're taking them down.
So,
yes. So there may have been these kinds of, well, even back to the election, there were accusations against Trump, and it didn't take him down. But now it's taking people down, powerful people down that maybe 4 years ago, it wouldn't have had the same impact. So you're seeing this as a sign of the change that a guy like Nick Foles, who was going to retire hang up his cleats a few years ago, ends up guiding the Eagles to a Super Bowl, and all these lawsuits taking down people like Harvey Weinstein and congressmen and senators.
Exactly. The outsiders come in bear markets.
Interesting. Okay. All right. So what do you think is going to be the pin that pops this bubble? Is it just gravity? Could it be a misstep by the Fed? I've talked to people about the fact that the Fed began to tighten, I believe it was in 37, while we were starting to recover. And then we had another bear market until World War II, while the Fed made the mistake of tightening. Exactly what's happening now. Is that going to be the catalyst?
I think the Fed is contributing, but I think that the other piece of it is investors' own extrapolations of what the Fed is going to do ahead. I mean, if you look at the certainty that investors have that there are going to be 3 or 4 rate hikes this year, they're doing the Fed's dirty work for them. And that extrapolation, I think, is what you're seeing flowing through the bond market. And that's the real issue, is that investors have taken the bond market one place and folks are just waking up to its impact on the stock market.
I see. Okay, so the bond vigilantes are back in force. I've noticed that there could be very long periods of disintermediation between bear markets and bonds and the equities finally reaching a tipping point to, like, for example, in 87, yields were going up, the dollar was going down, but before the crash, the market kept going up. So actually, didn't yields have really, they bottomed 2 years ago. So this has been already a fairly long period of rates not going lower and just edging up and not being able to make new yield lows for a few years. Do you think disintermediation can happen for a bit longer, or we're at that tipping point now?
Well, what's interesting to me is, and I tweeted this chart over the weekend.
You want to show it? I could hand you off the screen share if you wanted to show it. But.
No, that's all right. I can explain it quite simply.
Okay.
If you go back to the end of 2013, the market, the equity market, moved as interest rates were moving up in the 10-year. And actually, the 10-year reached 3%, with stocks moving lockstep up with it. And what is so interesting to me is rates were higher and nobody was apoplectic. Yes, we had the taper tantrum, but that was a bond market issue. Now
right.
We have rates actually lower than they were 3 years ago, and people are really, really freaking out about it. And that's a really important distinction. Lower peak in bonds, but much, much angrier sentiment.
Okay, so even though we're at lower levels, the impact is starting. So we're at 3%. It's going to be worse at 3% now than it was in 2013. And was that the peak in rates in 13?
Yes.
Okay.
Just a little over 3%.
All right. So we also have to talk about a lot of optimism about the new tax plan that was passed. What type of socioeconomic tell or market tell do you get from that happening at this time?
So the first thing I would say is that the passage of that itself is a statement of extreme positive mood. That Congress was actually able to come together and, approve and pass some kind of tax legislation is really significant.
Well, they didn't come together, but they passed it.
They passed it. It
was like Obamacare. Obamacare was all Democratic votes, and the tax plan was all Republican votes.
But there was finally a success.
Okay, a success. All right.
And what you've seen is markets top on good news, not bad. And to me, this is an indication, particularly for the financial markets, of really great news. And what you've seen is this huge present valuing. Again, markets, investors extrapolating the benefits of these lower rates, as far out as the eye can see, and turning that into higher earnings forecasts and higher multiples simultaneously. And that's exactly what you would expect at a major peak in mood, that investors are saying the future is so bright, I'm going to need shades, and I'm going to, in turn, boost my forecast. You were having, CNBC described it as this leapfrog effect, where analyst after analyst were raising their estimates, and at the same time, folks translating that into higher multiples. So I just think that you've seen this enormous present valuing of a very certain future that is almost certain to disappoint people.
Okay, so why don't we move? Okay, why don't we move to our bailiwick, which is currency? Mm-hmm. And the dollar's been in a bear market for, I don't know, about 14 months. I know it wasn't because Donald Trump asked for a lower dollar a year ago, our president, but recently there's been we've heard both sides of from Mnuchin. He said a weak dollar is good. We can export, and then the president came out and said we want a strong dollar. Does the dollar in any way play into some of this, the jigsaw puzzle that you're putting together for people?
Yes, because I think that you've got linking an enormous interconnectivity between equities, bonds, oil, and the dollar. And I think that the danger in all four of those markets is that people find themselves suddenly off sides. And the scenario that I envision, given the webbing that exists there and the positioning that I see, is that you have equities decline, bond yields decline, oil prices decline, and the euro decline.
Okay, so we could be approaching an inflection point for the resumption of the uptrend of the dollar after it's been going down. A weak dollar has been supportive for multinationals, et cetera, and a strong dollar is going to be a tailwind for commodities like oil and possibly gold, although I've seen them both go up and down together. Is that your forecast that a strong dollar could also be another pin that pops a bubble that has been aiding and abetting this euphoria?
Yes, because to your point, analysts have been presuming not only a weak dollar, but a continually declining dollar in those future earnings forecasts. So that too is going to put pressure on forward earnings that is going to come as a surprise.
Okay, so Peter, you advise people and you put out your views with your research. What are you telling people to do? Just buy 90-day T-bills and roll them and have a lot of cash? No one liked cash has been trash for 8 years now. Is that the advice? More about, instead of the return on equity, the return of equity?
Absolutely. And I think there are some places where there are fabulous opportunities to be long. I think that the repression that we've seen in volatility is a natural place to now be long.
Okay.
The short vol trade is extremely crowded. And I think that you could see the rubber bands, snap back particularly sharply there.
Okay.
I like to look at trades that people laugh and giggle at me, or think I'm a moron for suggesting them. And being long volatility has been one of those.
Like we're kindred spirits. But if you, especially if you were saying this for the past couple of years, then you're the boy who cried wolf, and no one believes it. You're, a lot of the bears, you don't even hear about them anymore.
Exactly.
And, okay, so and I interview very smart people who are, bearish, like Peter Bookvar, and a lot of people that were amazed. I was amazed by the magnitude of this move in equities. Were you a lonely guy for a while?
Oh, yeah. I have a great deal of respect now for all those Old Testament prophets.
That is a pearl, Peter. All right. So vol looks good. A lot of people, would you consider yourself a deflationist then in this environment? I mean, we're finally getting the Fed targets of where they wanted inflation to be. And what you're describing sounds pretty deflationary to me.
Yeah, and I think you're seeing that already in places like retail. The things that we want are deflating far faster than the things we need. But I think that whether it's going to be rental prices, energy prices, healthcare prices. I think that those three are particularly vulnerable to deflation, and certainly nobody is thinking that is even a possibility today.
That is really, yeah, that's a bold call. And, it's interesting you bring that up. There's talk in California about there was a law about rent control, and they want to expand rent control because people can't even work in the Bay Area. They have to commute for 4 hours because they can't afford housing, and they want to expand that rent control. That could happen everywhere because the middle class is squeezed by rents, housing costs, the three that you mentioned. That's why, when the Fed says there's no inflation, people go, what do you mean there's no inflation? Everything I buy, my food, my housing, my health care has doubled or tripled. So you think there's going to be relief, but with that relief comes a fairly poor economy, doesn't it?
Yes, sadly.
Yeah. Okay. So, Peter, a really interesting, contrarian type of take. It was great talking to someone to get the other side of the coin. I hear a lot of the other side of the coin. So, basically, you're looking for volatility to increase and the asset bubbles to pop. And during these times, Peter, what I'm more concerned about than a bad economy or what's happening in Washington is all the hot spots around the globe. Do you think that's also part of it, that we could have some type of conflagration anywhere? Is that in your telescope?
So,
yeah,
I do expect a couple of things. I think folks have missed the association between oil prices and ISIS terrorism, for example. We've seen oil in the last couple of years double in value, and you'll notice that we're now suggesting that ISIS has been vanquished. One of the things I noticed in the past is that as oil prices fall, we tend to see much higher levels of terrorism. And that is something that I think we just need to put on our radar screen as a potential consequence of declining energy prices.
Well, how about the relationship between Saudi Arabia, Israel, and the U.S. and decertification of the Iran deal? Do you think something could happen there? I've interviewed people who think something could.
That's not an area that I'm especially knowledgeable about, so I'm hesitant to provide insight there.
Okay, how about one more area? The Chinese have been stockpiling wheat dramatically over the past few years. You brought up the Old Testament. Joseph was the best commodity trader in the Old Testament, and he planned he had 7 years of plenty, 7 years of naught. Do you look at anything agriculturally? We have a La Nina year happening here in the Pacific, and as a commodity trader, that has led to poor growing conditions in the Midwest. You see anything happening in the agricultural markets?
I do. I think that wheat has been one of those. A couple of weeks ago, I commented that a logical pairs trade to me in terms of sentiment would be short oil, long wheat. I couldn't come up with a catchy tagline for that, but clearly energy costs look like they're going to come down at the same time food costs may rise.
Okay. Thank you so much for your time, Peter. I hope you enjoyed your time here. I found it fascinating, and I'm so glad I reached out to you on Twitter. I appreciate your time today.
I really appreciate the opportunity, Dale. Thank you so much.
Yeah, we all enjoyed it. Thank you so much, Peter. Good hunting. And let's get back together, say in about 3-6 months, and see how things are unfolding. Okay.
That sounds great.
All right, everyone, that was Peter Atwater. You could follow him on Twitter at Peter_Atwater. And there you see his website, Financial Insights, spelled with a Y, not an I. Thank you, everyone, and we'll see you tomorrow for Turnaround Tuesday. Good hunting, and above all, don't just count your pips, count your blessings. See everyone tomorrow. Thanks again, Peter.
Thank you, Dale.